Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for a weekly look at gold and silver. Things have finally broken out and gotten moving in gold. We were expecting this and discussed it in our last video, how once we broke out of this triangle we were looking at a couple of levels we wanted to break. We've gone on to break those levels, so there's no way of continuing the triangle pattern we were in, and therefore we could make conclusions regarding bullish or bearish options. I'm personally bullish at the moment. That is in line also with my long-term view. I'm very bullish on gold and silver long-term. I've been owning it physically for years, as well as being invested in gold miners, precious metal miners, as well as ETFs as well. So I generally have a bullish outlook, and we'll be talking about the long-term view as well a little bit in this video. We're going to look at silver as well, and I've moved the count from SLV to the CFDs on silver. It gives us more history to look at as well, and the price data is a little more manageable, less gappy, less messy. So anyway, without further ado, let's get on with what's going on here in gold. So this is the primary bullish count I have. Now we do have an alternate which we abandoned. We didn't abandon it completely, but we made it the bullish alternate a while ago. I said it was getting ridiculous because it relied on the just constantly expanding ones and twos, since we just didn't make another low. I think the triangle's a better explanation for what's going on. There is a bearish way of looking at this, which is that this is a connecting triangle, and therefore we are going to come up to come back down. That's also a possibility, but for the meantime, we should just take what we're given, I think. So, carrying on, this level at 1917, we pointed this out in last week's video. We were snagging around here at the time. I said a break above this basically eradicates the idea of this being a triangle that's still continuing. We had an option for a barrier triangle with a three-way swing to here, and then another three-way swing, and so on and so forth. That did not come about. Instead, we broke higher. So, looking at it currently, we've basically come back to the highs, right? Ish. Or within a tick of them. A bit of an assumption here, but it feels like a logical place to stop for the moment after such a rip higher. Now we could just power through this thing and keep going, but a logical place for a 1. Now we can't project a 1, but once we've got a 1 and a 2 we can project a 3, and then we can project a 5, and so on and so forth. But at the moment I'm just thinking this is a logical place to stop. So maybe come back now in a 2, and then we can carry on in a 3. That's just a hunch at the moment. So that's the bullish count working with the triangle, which is my primary, and will remain so for the meantime. What we can do now is we can change this bullish triangle invalidation. We can just change it to bullish invalidation and just move it up to the completion of the triangle. Not the dominant low down here, but the end of the triangle, because that's where our wave 1 begins. And in Elliott wave, we call that an orthodox bottom or an orthodox top, so wherever the actual pattern completed. So let's pop it there on the E. Let's move these back into place. That's the completion of our 4, and therefore this now becomes our bullish invalidation. So any move back below this, and this count is now invalid. There you go. 1754. Good year. So I've heard. Anyway, so that's the completion of our triangle, and now we're pushing higher. So now let's look at a couple of other options as well. Okay, so let's just revisit the alternate count for a moment, just for the sake of it. So all of this is bare now, because that's now been included in our primary count. But the idea here was that the whole thing completed a lot sooner into a 3, 4, right? And then this was a 1 into a 2, and this was a 1 into a 2, and this was a 1 into a 2, and now we're going 3, 4, 3, 4. So as you can see, it never invalidated, so it is still technically possible. So if this were to turn out to be true, and the 1, 2, 1, 2, 1, 2 is in here, then we won't get any significant pullbacks from here now, really. We'll be getting 3, 4 at this degree, 3, 4 at that degree, 3, 4 at that degree, and so on and so forth, and we'll continue higher on a 5th wave extension. Now, which is not that uncommon at all in commodities markets. It occurs far more frequently in commodities markets than it does in equities markets. The most likely extension in the equities market is always a wave 3, because it represents the greatest participation of both institutional and retail traders and retail investors. But in the commodities markets, subject to more macroeconomic changes, global stresses, and therefore fifth waves can become quite violent and overextended, but it's not a given. So that just leaves the option open of this being the beginning of an incredibly powerful move to the upside. Okay, so now that we've looked at two bullish counts, with our primary count still being the completed triangle, let's consider how else to look at this triangular pattern. So we've got a flat pattern idea, which is that we've had a 3-wave move to here, A, B as a triangle, 3-wave move to here for a larger B, so A into B, and now we will get 5 waves down. Okay, now we had to make 90% retracement of this move for it to be a legal flat, and we've done that now. So we do have to be on guard here for a shift in momentum. If we collapse violently from here, and come down in an impulsive fashion of 5 waves down, then 3 waves back up could suggest 1 into 2, and we're going to come down 3, 4, 5. So seeing how that develops, that could be a short opportunity if you are of a bearish mindset. If you have a bearish count and you prefer this idea, then be on guard for that opportunity, because that could be a 1, 2, 3, 4, 5 down into a 2 back up. If we are bullish, we will see a 3-wave move back. Okay, if the bullish count is correct, it could be a zigzag, it could be a flat, right? But then we'll continue higher. So if we do get an impulse down here and volume comes in to support it and momentum rolls over and starts to support a downward move, we can consider this flat option. Okay, and we have our clear invalidation point for our bullish count, which we've already mentioned, which is back here at 1754. Okay, now we could also interpret it as a double zigzag with a triangle in the B wave of an ABC of an X. There really is very little difference, because whether we get 5 down into a 1 or 5 down into an A, you're still going to get 5 down. A bearish move from the high here will begin as a 5-wave move, whether it's going ABC or whether it's going 1, 2, 3, 4, 5. So essentially they will resemble the same pattern on their way down. So they're the bearish counts. I'm personally going to remain bullish unless I see strong evidence of an impulsive move from a high downwards. So in the meantime, I'm expecting a pullback and then a push higher. If we continue to rip from here, a pullback will inevitably come because we've gone vertical. Okay, so we have to kind of cool off at some point. So if we just bring up our momentum indicators for a moment, we can see how, now for some reason, my MACD isn't here. I wonder if I've deleted that by mistake. Okay, let's just get it back up. There we go, using my default settings. Right, so let's have a quick look at what we've got here. Let's delete these now. I was using this to try and frame the idea of it being a triangle. So, and it was working pretty well. Right, momentum was fitting quite nicely. RSI was supporting the idea that it was a large triangle. But that's now been broken, so that helps us confirm the idea that whatever this was, corrective triangle in a B or a completed triangle, it is obviously over. And we've now continued higher back into overbought conditions around 85.45. We got to higher than the B wave swing here of the triangle. That's a positive that we've come back to a higher RSI reading. If we had significantly weaker RSI readings off of this high, weaker than any of these highs within the triangle, that would have been a pretty strong negative that there was bearish divergence here. Now over the longer term, coming back to the previous high, you could argue that you've got divergence between current highs, but I would argue it's fractional if it's there at all, and I'd argue that having come all the way to oversold on multiple occasions, that's not the way we should interpret RSI. We can't just link up two highs from God knows how long ago and point to divergence. Okay, if we reset the RSI multiple times in the meantime, we have to look at more recent highs and how they relate to one another, and then we have to look at it in our MACD as well. And we can see here we have the same triangular shape, right, which is now completed, and a move higher. The strength of this move is greater than any of the subsequent moves within the triangle. That supports this breakout as well, and that there is some bullish momentum behind it. Given the larger pattern though, we have to wait and see if we reverse it. If we do reverse it violently, there is still the possibility that it's a deceptive B wave and we're coming down in the C. But it looks at first glance a little too strong to be a B wave, I would argue. But yeah, given the circumstances driving the buying at the moment, perhaps it could be more deceptive than we realise. Okay, so they're basically all the options I can see at the moment. It's either a bearish triangle completed as part of the correction, so we had a move here, move to here, and the triangle was a B, or it's bullish like this. And I'm going to side with this for the meantime. If we came down to the 38.2, which is roughly where we would expect a way forward to complete, we've gone through it with the A, through it with the C, and finished above it with the E. So in the region between the 23.6 and 48.2 retracement for a larger wave 3. So if we just come out for a little bit and look at the larger time frame, you can see that the 38.2 is providing support, but the 38.2 off of our primary pivot 1-2 back here for our pitchfork was also providing support the whole time as well. Okay, and what we'll have to do is just turn off the count so we can see clearly. So I mentioned in the previous video that this 38.2 was providing constant support, and while it held, things were still looking more bullish, that we were gradually setting higher lows. But if it broke down, we were likely to get a run onto the edge of the pitchfork. Well, we did the opposite. We went between these levels and the median line and the 38.2. And once we broke that median line and broke this triangular pattern down, we've now made a run onto the 61.8 by the looks of it. Which is, I think, the all-time high is taking precedent here. So you can see how, given the room of this move, I mean, we could break out of this thing and go nuclear. You know, it's possible. Probably a bad choice of words, that, sorry. But I think if we're going to take our time up here in the fifth wave, whether it's just starting, whether it's a giant extension, whatever, then we're going to have to try and buy some time. Come back and test the median line would be a logical place to do it. Maybe come back into the summer. And then we can push up in a mighty wave 3. And then we can come back. And then we can push up. And we can, you know, take the fact that this is a wave 2 here, and this is a wave 4 here, and something over the long term that resembles that would, I think, would make sense. It could be over a lot sooner than that, but if it is over sooner than that in time, I think it will run up faster and more violently, because as I often say, what you don't gain in price, you gain in time. What you don't give up in price, you give up in time. Okay. So that's gold, essentially how I see it. Long term, I think this is part of a much larger bullish pattern. I think that can be expressed better looking at the silver market though. We might come back if we have time, so let's move on now and look at silver. So, I've had some issues with silver. I've been saying for the longest time that this was a wave 1 off of the low, and that we were looking for a wave 2. Now that we've rallied, this is what I've got. So, I'm not perfectly happy with it at all, to be honest. It is a different pattern from what we're looking at gold. We would expect that. If we're saying a triangle in gold, we can't have it here in silver because we're saying wave 2 in silver, and you can never have a triangle and a wave 2. So we ended up with a couple of ways of interpreting this. So I think I should probably start with the bearish count, as that was the established idea. So let's just long-term bullish, short-term bearish, I should say. So the idea here was that we were working on a triple 3. and we had this was the first three, zigzag, this was the second, and this was going to be the third, joined by an X wave here and an X wave here. So this is still possible, and if we get that violent reversal in gold, we'll get it in silver as well. And if we get 5 waves down in gold, that could be the 1 into the 2 of the flat, but here I would likely suspect that it's A into B, looking for C to find the golden ratio before finally completing this. I am undecided at the moment which I prefer, but I'm going to have to call the bullish count, which we'll look at in a moment, my primary, because it lines up with my expectations for gold. Open to reversing that idea if things break down from here, but generally at the moment, seeing what we're seeing, I think we should, I'm going to remain bullish until proven otherwise. So that's one way of looking at it. I've had to find a way to get the count to conclude here. Now, because we've got other ETFs to look at, and we have been looking at the SLV, we got a slightly lower low here, so I'm not going to cheat by saying 1, 2. Okay, I'm going to get it to conclude here. Alright, so let's now bring up the bullish count, and this is what I see. I see a channel that's broken to the upside, so that's a positive. I've still got the 1 here. I've got WXY. That's the same, except instead of it being WXY XZ, we've got it to complete here. Now it's a bit ugly, so let me just talk you through it. We'll get rid of this parallel channel, as it might be distracting you a little bit. And we'll come in and zoom in on this. So this is the same. Okay. That's the first zigzag. This, however, is different. This was the zigzag I used in the bearish count. Now what I've done here instead is this. Like I said, not particularly pretty. But what we have is a 1, 2, 3, 4, 5 diag into a larger diag of 5 waves into an A. Leading diagonal into an A. And we can see the 5 wave subdivision here supports the idea that it's a leading diag. We still get that overlap of the 4 over the 1. Right. As opposed to an ending diag where we would expect just a series of zigzags. We then get what I think is a 3 wave move, but then I think we get a 5 wave move in here. I definitely feel more like it's 5 than it's 3. It doesn't subdivide well as a zigzag here. Okay, so I see 5. So that says to me A, B, small c. Essentially holding all of this, not wanting to give up all of this price support, right? From that point, we can complete the count as A, B, C, W, W, X, Y, X, A, B, C, Y into 2. Then we go 1, expanding flat into a 2, and now we're accelerating in a 3. So I don't have it completing here yet like I do in gold. So we could get a little bit further in silver. Perhaps we could get a little bit further in gold. Maybe make a new high. And then find our larger 1. Come back for a 2. Then get out of here. That's going to be my primary for the meantime now. Because it's in line with my bullish interpretation with gold. Same caveat. Momentum shifts negatively. And we get an impulsive move out of here. 5 waves down. Then we can consider this to maybe be the bearish counter. We're going to come down and make that lower low. But it's too early to say that at the moment. And we've spent a fair old time consolidating as it is. Like we said, since August 20. And it is now March 22. So there we go. That's silver. And like I said, this is my favoured count at the moment. So now let's talk about the longer term for a minute. Just to give you an idea of how bullish I actually am. So you could think this is Moonboy talk, but I've been of the opinion that technical analysis, especially Elliott wave, is essentially an indicator, given our limited ability to understand it or a limited ability to practice it. I'm a big fan of the theory, but I think being humans, we are limited in our interpretation. But I feel it is essentially predictive. And therefore, whatever fundamental reasons we're going to encounter to describe price are already there on the chart, waiting to happen. And I feel the trend over the long term is devaluation of fiat currencies. I feel the trend over long term is inflationary towards the destruction of money. I feel the instability in the world, the squeeze upon resources, population pressures, you name it, whatever. I lean into the idea of gold and silver being long-term bullish for all of their fundamental reasons that could be the case. Alright, so let's back out now to the longer term. And what I'm going to do actually is I'm just going to take the count off the chart so I can explain my idea over the longer term to you. Right, so here we are. We're going to look at a low back here in 1932. That was the end of the Great Depression, the bottom of the Great Depression across, well, basically all markets. So obviously the trend has been up, right? Nobody can argue that. Upward trend over that period. It's been a big move, obviously. It's been 17,741% to the previous high, to our current previous high. Now, what I find interesting about this structure is the following. Let's just measure some stuff here. This is 17,000. What is it? 1,700? No, 17,451 days. Excuse me. 17,451 days. This move. This correction is 4,823 days. Okay, so let's just package this whole thing together as one span of time. This is 22,379 days. So let's now do the next one, and I will make my point in a moment, I promise. So now we're looking at 6,580 days and a correction period of this move. We're looking for 3,241 days for a total time, assuming it's over, for a total time of 9,828 days. Less than half the amount of time it took to do this. So what I'm essentially getting at here, guys, is that we are not looking from the start of this upward trend, we're not looking at something like this, are we? That would be a nice clear impulse. What we're observing here is a move that's big, a big move, and then we're observing the same move again that's smaller, and then we're observing another move that's smaller again. What I think's going on here, guys, is a nesting pattern of a gigantic extension. Now I know that's uber bullish, super duper uber bullish, but that's what I think is happening here. I'm thinking we've got a 1 and a 2, and this is a large degree, likely super cycle degree. And then we've got a 1 and a 2. It looks the same, right? It looks the same, but it's smaller. So this is a 1 and a 2 of a primary degree or cycle degree to this cycle or super cycle degree. Now this looks very small. It could be intermediate degree to primary, but it could be minor. So what I'm thinking is you're going to get another 1 and 2, right? And this one will be smaller than this one, which was smaller than this one. And we're actually just building an absolutely gigantic extension in silver and gold. And gold counts similarly, but further ahead. Even in the shorter term, it's further ahead in the count than silver is. But it's the same idea. Okay. Now I know that seems extremely bullish. But that's just the way I see things going. Now, we could talk about fundamentals forever. I don't tend to discuss fundamentals anymore. I tend to focus on technicals. Now, believe me, I spent years going over fundamental arguments. The problem with fundamental arguments is they're sound, they seem to make sense, but you're not alive long enough to see them play out. Or if you are alive long enough, you give up after 5 years of saying the same thing, or 10 years of hearing the same thing. No one has the lifespan or the patience to observe a macro multi-generational move in an asset. Nobody does. So when you say things, so like you'll have guys out there, and I won't name names, who are uber bullish on something, and they've been telling people to buy gold or silver or whatever, and they've been doing it for 5 years, 10 years, 20 years, and people have had to sit through extremely long-winded corrections getting nowhere, and therefore have no appreciation of the longer-term macro view because they haven't felt the benefits of any of those subsequent moves or prior moves because they brought during a bad time. That's how long shit takes to happen. It just takes a long time, right? So that's why I feel constantly discussing fundamentals in reaction to world events and short term is a waste of time. Okay, I will go so far as explaining what I think is going on for a couple of minutes now, and that's the only time you're probably going to hear me discuss theoretical fundamentals. So, any long-term macroeconomist, especially of the Austrian school, who I have a lot of respect for, will point out quite clearly that the dollar has been on a never-ending course of devaluation over 100 years, right? And longer. You know, as more money came into existence and the United States grew bigger and bigger and bigger, and its markets expanded and there was more and more money available, the actual buying power has reduced over time. Now that's just logic. That's not some great insight or clever insight. It's just logic. Now, what if we take that macroeconomic view and we look at it over the shorter term for a little while? We know that there's a correlation between the dollar and other commodities and other markets. However, we know that the dollar's been in an uptrend since 2008. Stronger today than it was then. Since the end of the GFC. Excuse me. And yet the level of quantitative easing, the level of money printing is biblical in that period. Mind-blowing. Relative to anything before. And yet the dollar has not raced to get to zero as many people would have had you believe it would have done given such inflationary printing, and yet the dollar's gotten stronger. So the issue we've got here is everybody's doing the same. Every fiat currency is garbage because it's not backed by anything. They're all backed by dollars because the dollar is the reserve currency of our species. This gives it a unique strength and a unique privilege. It doesn't necessarily mean it will last, but why would anybody else get to inherit it? Right, we're all doing the same stuff. So the dollar can strengthen while printing trillions upon trillions upon trillions of them. It can still strengthen because it is essentially the least smelly pile of dog shit in a pile of dog shit currencies. Right? Those dollars easily find their way into financial assets, hence the stock markets being at the highs they're at. Gold and silver and other commodities suck them up, and prices like a sponge soak up all of those extra dollars. That's inflation in a nutshell. You print more and more money, prices will soak it up. So gold and the dollar, oil and the dollar, equities markets and the dollar, they've all been doing the same thing lately. They've all been getting stronger at the same time. Seems counterintuitive, but long term, well, let's not get distracted. The point I'm trying to make is there's potentially almost unlimited space for gold and silver to run, right? Because what we're witnessing it's not intuitive. This idea that the dollar is going to zero and it'll be there tomorrow because we just keep printing money is self-evidently not true, right? Hasn't been for over 10 years now. Okay, We can see it on the DXY chart. Go and look at it. But what we do know is the buying power of it has been reducing accordingly, even though the dollar has, inverted commas, been strengthening. So that's inflation in a nutshell. You've got the prices are sucking up the liquidity provided, but the dollar itself is stronger against other fiat currencies. That's the bit when I think a lot of people miss. We're all falling through the sky together, right? So the dollar's falling, the pound's falling, the euro's falling, the yuan, so on and so forth. We're all plumbing towards earth because we're all a bunch of dogshit currencies, right? But the dollar's falling slightly slower than the rest because it has this special privilege that the others don't. Meanwhile, all of the money printing across the globe continues to get sucked up by all of these markets. Equities markets, we've seen it. We're seeing it in commodities now. So, you see what I'm saying? The dollar is still likely going to remain the safest form of fiat currency and get stronger while everyone expects it to get weaker, as it's done over the last decade. When it should have been getting weaker by Austrian economics logic, it's been getting stronger. It strengthens against other fiat, but it still causes massive inflation across the board. And that's how gold and silver have infinite room to run. And you could argue the same for any other market. You could argue the same for almost any other market. So that's it. I'm just going to talk fundamentals on that for a few minutes. But that's what I think we're dealing with here. We're dealing with 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, and then that's that. Now, will the day come when we get into the final fifth of the fifth of the fifth? At that point, the Austrian economists are spot on with the dollar and it is worthless by them. Yeah, but I guarantee you so will be every other fiat currency. I would be willing to bet on that. Alright? So, mustn't run away with the idea that the dollar's doomed. If we're saying the dollar's doomed, all fiat currency's doomed. And if we all accept that, then gold and silver are a very logical long-term purchase. Okay, so that's all I'm going to say there, guys. I hope I haven't bored you with fundamental talk for a minute. And if you disagree, feel free to mention it in the comment section below and tell me I'm completely wrong. But I've been in the markets over that period and I've seen the opposite happen to the dollar of what all these people were predicting. However, I've seen the inflationary impact of money printing reflected everywhere, especially in financial markets. So there we go. We'll leave it there. I'm going to stick with that primary. Where is it? The bullish count for the moment. It could reverse and come lower. Okay, as we spoke about in gold. But even if it does come lower, my long-term view for silver and gold is extremely bullish. Alright guys, thank you very much for joining me on this technical analysis of gold and silver. If you're new to the channel, you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, huge thank you to my Patreon subscribers. Your support is greatly appreciated. I think the live stream this week is probably going to be tomorrow, Thursday. You'll be getting this video later today, Wednesday anyway. And yeah, I'll speak to you guys soon then. All the best. Bye bye.